Hi, I'm Pattu from FreeFinCal, and let's talk about why we should not expect returns from our mutual fund SIPs or mutual fund investments in general and do something else. So this is a continuation of yesterday's video, which is linked in the description box. Yesterday we saw that SIP started just a couple of months apart, have a huge difference in returns because of the volatility in the markets, and this is essentially why we cannot say if somebody asks what return can I expect for the next 3 years, 5 years, 4 years and 10 years and so on, you just cannot give a number. We'll talk about why that is the case. So let's dive right into the data. Keep an eye on this number here. This represents the number of data points in the curve in this plot, and every blue dot here represents the return of a 5-year SIP in Franklin India Blue Chip Fund. This is one of the oldest mutual funds in India. It's also the oldest large cap fund. And look at the returns. The returns range from anywhere from 0, less than 0, all the way to 50%. And this is from December 1993 to somewhere 2014, mid 2014 and so on. So let's say you're going to start SIP in Franklin India Blue Chip or any large cap fund for that matter. Please look at this graph and tell yourself, convince yourself what return will you get. Will you get 50% return, or will you get 0% return, or will you get anything in between? And there are two things I want you to keep an eye on. One is the number of data points, 242, which is pretty small. And look at this window. This is the horizontal axis tells you the range over which the investments were made. So we are computing returns for investments made between December 1993 and somewhere in the middle of 2014. That window will keep decreasing as we go from 5-year returns to 10-year returns to 15-year returns to 20-year returns. So this is 5-year returns. What return? What can you expect? Nothing. If you go to the AMC website, and especially for large cap funds, they will tell you people can invest for minimum 3 years, 5 years and so on more. What return will you get? Nothing. If you ask a distributor, they will say 10%, 15%, 12%, whatever. They'll give you numbers because they want you to close that. They want you to sign up their SIP. That's all they want. Nobody can predict anything. I don't know what else to say. So that's 5 years. Yeah, I'm making this video particularly because yesterday, in response to yesterday's video, people asked, if I do this calculation for long term, so yesterday I had done this 5-year for DSP small cap. If I extend this period for longer durations, will not the fluctuations die down? Yes, the fluctuations will die down, but not as much as you think. And something else happens. Two things happen, and you will not like it. Let's see. Let's see what happens when we go from 5 years to 10 years. So now we are looking at 10-year SIP. Each blue dot is a 10-year SIP return. There are 182. So from 242, we have now got down to 182. That's like a decrease of 30%. Let me just open the other PCs where I can have a look at some numbers. So that's a big decrease. And look at the horizontal axis. The window has now come down from January 1993 to just before July 1993. So again, the window keeps closing down. That's the problem when we go to higher and higher durations. And notice what is happening. Look at this trend here. Do you see the trend? It's going down. Can you even expect 10% return? Because this trend is going down. Maybe if you ask a trader, they'll say they'll draw lines, support resistance lines, and say it's heading all the way down here. Can you even expect a 10% minimum return over the next 10 years from this data? You can expect because of your belief. You say, oh, India is growing, GDP is growing. All this propaganda nonsense I can also do. But if you look at this actual hard data and you see this curve tending down, can you, convince yourself truthfully that you can even expect 10% return? From this data set, I will not. I don't know. The answer is I don't know, and I don't think we can expect 10. Don't start saying, oh, look, minimum return is above 10%. This means future you will get 10% more than. That's just nonsense. Why on earth would they say would they give you that past performance disclaimer? So it can be anywhere, literally. And that's 15-year SIP. Now you only have 122 data points, and we are only looking at investments made between December 1993 and around early 2004 or something like that. So that's just a 10-year window. We are looking at investments made in a 10-year window, and that's an extremely short window. Even in that extremely short window, the 15-year returns are also dipping down. What return will you expect? 15%? 12%? 10%? Or can you say, oh, I will expect minimum double-digit returns at least before tax and so on? What nonsense! The truthful answer should be I don't know. And again, the validity of the analysis keeps decreasing as we go from 5 years to 15 years to 5 years to 10 years to 15 years, because the number of data points are decreasing and the window in which we started the SIP is also becoming narrower and narrower and narrower. So it's not reliable. That's extremely important to understand. So you should not look at only the fluctuations. The point is, when you look at a rolling returns graph, do not look at just this the swing in the vertical axis. Look at the width in the horizontal axis. That also matters. If it narrows, the validity goes down. Right? Now from 15 years, let's go to 20 years. 20-year SIP, there are only 62 data points, and it is the investment made between 1993 and somewhere in 1998-ish or so, something end 1998. That's like a 5-year window, just a 5-year window, and you cannot look at that and say, oh, because investments made between 1993 and 1998 gave 15% more than 15% returns, that means an investment made for 20 years will be more than 15%. How can you do that? You can't really say anything. There are just 62 data points. This is the reason I keep saying, stop looking at past performance of the Sensex and saying last 30 years Sensex gave this much returns. You will be the India that was there in the last 30 years will never be reproduced in terms of economy, in terms of lifestyle in the next 30 years. In the next 30 years, we are heading into a very different country. The India that was the 80s India was very different. The 90s India was very different. 2010s India is very, very different. India is continuously changing. We are now gone from a backward country to a developing country to an emerging economy. We are actually on the brink of becoming a fully developed country. So you can't expect this, and we just don't have any history to say anything. Look, I'm not a sales guy. People say, oh, you're discouraging new investors. I don't give a shit. I don't want to say wrong things and make people invest in equity because it's a financially literate thing to do. I don't care. They should know the truth. Oh, for God's sakes. Okay, so that's that with Franklin India Blue Chip. Now you should have a look at how the US markets behave. We have S&P 500 data all the way from 1875 or something like that. We cannot use data in the 19th century because Excel won't handle it. We can use data only from January 1st, 1900 onwards. So if you take the data from January 1st, 1900 onwards, and I have done this calculation a couple of years ago up to May 2015. So there are something like 1025 data points there, and each data point is a 15-year SIP in S&P 500. The US was not a developed country in the early 1900s. It had serious problems. There's depression. It went through wars and so on. So there were serious problems. It had crises even in the 70s. It had different crises and so on. So look at that. See, all these bhajans, these financial advisors sing about SIPs in India. All those bhajans have been copied from the US market or anywhere else. Those bhajans, the US bhajans are also wrong, because if you look at that 15-year SIP, what they call as dollar cost averaging, that is what return can I expect from this S&P 500? Of course, this is the price data, the dividends have to be added, but that's like 1-2% more. Still, the fluctuations will still be the same. That's a huge range. Excel can't even calculate returns here. Anywhere between 0 to 16%, and it goes up and down. It's cyclic. That's what we saw yesterday. Returns matter, depend on when you invest and when you start redeem or when you calculate. So that's 1025 15-year periods, and I did this calculation just now for this video. There are 1145,145 20-year data points for S&P 500, again for the same duration. Look at that. What return? Again, nothing. I can't say anything. So even in the US, even today, I'm telling you this, USA, oh, this is US data, this is different from Indian data because India is an emerging country and all. All these bhajans they sing today, even today in the US, they sing the same bhajans. They say you should have start an index fund, index ETF and S&P 500, put money in it, it will grow, it will beat inflation. All these bhajans, they also sing. Those bhajans are also wrong. It's completely wrong to expect anything from equity simply by putting money every month. That is just stupid. It's the except for the AMC and the distributors, it's a stupid idea for the investors. They should learn to manage the risk actively. So this is another criticism. You're always talking about problems. Yeah, I've been blogging for nearly 7 years now. For the first 5 years of my blogging life, more or less, I was talking only about solutions. And probably recently I started talking more and more about problems in a slightly more flashy way. Because for every 100 people who see the flashy posts talking about problems, 2 or 3 people read the solutions. This is the reality. Most investors are idiots. This is the reality. So I'm going to talk only about problems. If you want solutions, go search my site. Well, or see my other past videos. People don't want to do that. It's easy to criticize, right? Well, the solution is simple. I've been saying this. This is my frequent cal bhajan. Have a clear goal. Invest about 50 to 70% equity allocation for a long-term goal, and the rest in fixed income. Reduce equity allocation not just before your goal due date, but in a stepwise manner. There is a video. I'll link the video here so that you can reduce risk. Focus on the target corpus. Do not have a target return. You can see how I do it in my audit video. All that also I will link. Do not expect any return from an SIP. Expect a target corpus provided you have a clear risk management strategy in place. Systematic investing means having a system. Investing every month is not a system. That's automation. You have a system of asset allocation and how it should be varied. Then you can invest each month. Then you don't have to expect a return. You expect a target corpus and rebalance and adjust the corpus according to the requirements of your goal. So let me reiterate, do not expect any return from your mutual fund SIPs. Do this instead. So I'll catch you again in another video. Bye bye.